On today's hot sheet, I'm discussing Powell's report to the House committee. Yesterday, day before yesterday was the Senate, now the committee. The producer price index report is out, some more inflation news. Barbara Corcoran and Ryan Serhant's takes on the housing market, and a weekly unemployment report. Today is Thursday, February 13th, 2025. I am Byron Lazine, and the hot sheet starts now. All right, welcome into the hot sheet. Let me know in the live chat which market you are tuning in from. I was just saying to Haley, our great producer over here at BAM, works on the hot sheet often. You guys know Haley. She is the person who got Monday off while the rest of us were working, but I won't go there. Anyways, I said to Haley coming into today's hot sheet, I said, I think I've been late every single day by a minute or two going live on this week's hot sheet. So I would say, I just want to, not making excuses here, I got to do a better job of wrapping up my commitment before the hot sheet. But most of you probably don't know this. But right before the hot sheet, every single Monday through Thursday, I'm doing a live role play, okay, with the team. So that's going to be something for those of you that are in BAMX. That's going to be something that we're going to start doing in BAMX right before the hot sheet, the live role play. I'm going to start doing probably Tuesdays, the role play that I'm already doing, opening that up to more so more can benefit from that. And for BAMX members, you're just going to find that in your calendar here on BAMX. There's actually on the 26th at 3, there's going to be an office hour live role play, but I'm going to start putting some 9 a.m. spots here on Tuesdays. So that'll be before the hot sheet. I guess just look out for that. If you're a BAMX member, you're just going to go to your calendar there and find that. Also, for those of you not BAMX, go to school.com/BAMX. Get access to obviously 30 plus on-demand courses, but also the hot sheet daily market data. Like, look at today's data and slides are already up every day that the hot sheet is on. We do this for you. Every BAMX member also gets access to a personalized platform through Zoodealio to generate 4 offers on every listing and help you get more listings. So I hope you take advantage of that. All right. We got a whole bunch today on this Friday. Jerome Powell was back at it with the House committee. Jerome Powell, I'm not going to go through everything because we kind of covered, he covered, if you listen to yesterday's hot sheet, he covered the same answer multiple times to the Senate. So we're not going to go through everything, but about 2 hours in to this testimony in front of the House committee, Jerome Powell, who responded to a bunch of the same questions and statements, we've sifted through all that and found the most relevant on top of what was done in front of the Senate as it relates to housing. So, Haley, I'd like to go to 2 hours, 7 minutes in. This is a question from Vicente Gonzalez. So let's go to House Member Gonzalez.
The Cleveland Fed's new tenant rent index tumbled to a negative 2.4 year-over-year rate. Does that type of deflation in shelter make you more positive on future interest rate cuts?
So yes, but the thing is, what we're really looking at is in the aggregate housing services inflation. I believe that's a measure of current rents, so market rents that are happening, and market rents have not been showing much inflation for a long time. Market rents don't make their way into rents until leases turn over, existing leases turn over, and that's been the slow part of the process. We have seen a lot of progress on that, but we're not there yet. We're not back to levels of housing services inflation, which is what I described, but we're getting there. We're making clear progress.
And that lies the problem. And so I've been railing against this forever. Yesterday, we talked about it with the CPI report. Owner's equivalent rent, which makes up 26% of CPI, which is the that's the metric that the markets look at the most, the equity markets anyways, and how they react to inflation. 26% weighted is an owner's equivalent rent as opposed to real time rent. So, shelter is one of those things that's driving inflation the most, and it's a really bad metric. So, I don't know. Jerome Powell says it all the time, like, hey, real time rents are down, and that's what's happening in real time. But in order for our calculations for those, old leases, 1-year-old leases, they have to expire to really roll off. So I don't like, if I'm Mr. Gonzalez there, I follow up with like, well, can we get rid of owner's equivalent rent then? Like, what would it take for us to get rid of a 1980s survey that is no longer relevant? Like, can you break that down for me, that thought process? Is it too hard? Are we not willing to do it? Like, what's the reason why we're latching onto that? Okay. So that was the really only big takeaway there for Powell. There was inflation is still sticky. We learned that yesterday, and we're learning that again here today as the PPI has just been released at 8:30 a.m. Eastern. The PPI coming from the news release of the Bureau of Labor Statistics. Isn't it interesting that Bureau of Labor Statistics, Department of Labor, puts out all of these numbers? It always seems interesting to me, but maybe that's just a naming thing. The PPI for final demand increased 0.4%. Okay. So that was in January. The expectation, though, was 0.3%. So this is not great news. Back-to-back days, CPI and PPI on inflation. Okay. So inflation is coming in hotter than expectations, showing that it is going to take some time to get to that Fed's mandate of 2%. Right now, we're dealing with a 10-year that really on today's news isn't doing terrible. It's actually down a little bit, which is kind of surprising there at the 4.552. So that's good news. We'll take that. If we go back to yesterday, we got up over 4.6. So we're still at over 4.5 comfortably. We're not where we were 5 days ago. We're in the 4.45 range, but 4.55 on the 10-year. The reaction since this PPI, these numbers have come out, even though it was worse than expected, isn't that bad. So maybe we'll get a little bit of a cool down from the 30-year fix yesterday, which, as predicted, did move up to 7.13. I made put a tweet out yesterday. Let me see if I can find it. I'm sure I can find it because I just did it, and I know how to find my X account. Let me go on X here. I think I might have even posted this. Maybe I posted this in my Instagram story. I'm not sure. Let me know in the comments if you agree with this. Okay. This is where I'm at right now on the interest rates. Like, in 18 months from today, I think that 6% mortgage rates are going to feel low. 17% of homeowners right now have a rate of 6% or higher. So just think about 18 months forward as we deal with a lot of 7+ this year in 2025. Hopefully we start to see a trend line moving down, but we're going to deal with a lot of 7 being normalized. And when you look forward in 18 months, how much is that number of 17.2% homeowners going to have grown over the 6%? And then as we do get maybe some of the, like we were talking about yesterday, maybe some of the deficit problems solved, maybe we do start to see that rate come down, those long-term rates come down. And in 18 months, if we're at 6% and we've gone through another year of higher than comfortable than we are being comfortable with the rate, 6% is going to feel really low. And a lot of people have a rate above that. Yesterday, again, came in at the 7.13. Same day last year was 6.96. I don't know, Haley, if you can go to maybe that, there's a Serhant comment. I think it's maybe 30 seconds into that video from Serhant. I know we're going to get some Barbara Corcoran comments here, but if you can go to the Serhant clip, and I think you'll go to, I don't know, go to maybe a minute in. I'll tell you if you got to go back. They're having a conversation. This is on Fox Business. They're having a conversation about, go to, where are you at right there? A minute in?
Yeah, minute 32.
All right, go back to a minute. Go all the way to a minute. Let's try that. And so this conversation, they bring up rates. Just play it here. We'll see where it is.
Indicators that are pointing to significantly lower rates. I think the depressed rates that we saw for 12 years post 2008 was just a long last.
So it's pretty early. I just want to skip all the congratulations on the Netflix show, which is amazing, but
I'm looking at the backdrop for that and the people's curiosity and real fascination with real estate. And then I'm seeing this T. Rowe Price report out today that they are looking at 6% plus 10-year note rates, 10-year bond
long-term rates,
which means, 6.8, 6.9, 30-year mortgages could be 7.8, 7.9 mortgage. If they're right, are they right?
I think so. I don't see any great macro or micro indicators that are pointing to significantly lower rates. I think the depressed rates that we saw for 12 years post 2008 was just a long lasting response to the subprime mortgage collapse of 2008. And no one wanted to ruffle any feathers to change that until COVID hit and we hit this mass state of inflation. The housing market is dictated by only three things, really, which is interest rates, supply, and demand. We know there's demand.
Right.
There's significant demand.
You can drop that, Haley. So interesting there. They're having the conversation about rates. There are projections that these long-term rates get even worse, which pushes up a 30-year fixed rate. And the analysts from Fox Business saying to 7.8, 7.9 territory. You start getting a certain amount of time at those levels. 6% feels real low, right? 6%, often the mental barrier of 5.99 can be achieved when you have a true 6% rate. I mean, I get locked in at 5.99 in 18 months. Imagine how many people are going to be bragging about their 5.99. Like you've got a bunch of people bragging today about 3.99 and 2.99. The homeowners that brag about 2.99 that are like living in their house, it's just something to brag about. I think Josh Rubin made the point kind of brilliantly. Maybe he stumbled into it on Knowledge Brokers last week, where it's like, people don't make decisions based on like, I'm so emotionally attached to 2.99. Okay. They're just talking about it and bragging about it because it makes them look smart. They had great timing, but it makes them look smart. The same reason somebody shares something on social, it's valuable information to them. And so it's like, hey, I found this valuable. It appears to make me look smart because I think it's going to be valuable for you as well. So when people are sharing that information, they're trying to sound smart. But really, one of two things are true. Either it's the perfect house for them and they're not moving, or they can't afford to move. If affordability is out of the equation, what Josh Rubin said was, you're not going to live in a house if you can afford another one that solves your lifestyle, no matter what the rate is. So it's either it's the perfect house or it's an affordability issue. And Serhant goes on in that clip, and I shared some of that in the Real World podcast earlier, was like affordability is the crisis. That is the true crisis. What he also, alluded to there was pretty interesting about just where we're at on these rates and kind of like, why have the rates been suppressed? It's the activities that we've seen in response to the subprime crisis. John Burns Consulting had a little bit of a different angle yesterday on some of the things that Powell was saying. So this came out yesterday in response to the Senate hearings that we went over yesterday in the hot sheet. The headline on this X post from John Burns Consulting is Powell is misleading Congress, which is interesting. Okay. Like Powell, and we covered it yesterday, said, I can't impact the long-term rates. Like, stop asking me about the 30-year fix. Stop asking the same questions over and over again. I can't have that big of an impact. Like, we saw it. What he's saying is true. Like, what he's operating on, what the FOMC decides is those short-term rates. They lowered the short-term rates twice in 2024. And what happened? 30-year fix went up. So they didn't have control over that. The 30-year fix right now, and the demand for long-term rates to invest in America's long-term future is much lower. So that demand in America's future for long-term investment is much lower than it has been in the past. Why? Because the debt bubble is growing at an exponential rate. The $2 trillion gap on just this year's deficit is wild. The amount of interest that we're paying is more than the defense budget. Okay. And so the investors are like, they're going to have to do something. They're going to have to make massive cuts. They're going to have to, produce, a new level of GDP that they haven't been able to obtain, or they're going to default. Right. So that's how that long-term rate can be most impacted. But what John Burns Consulting is saying is that Powell made a misleading statement by not telling the whole story. While it's true that the long-term rates are high for the reasons I just articulated, also said it's true that mortgage rates remain high, but that's not directly, and that's not so directly related to the Fed's rate. And so saying everything we covered yesterday, that's true. It's not directly related to the Fed's rate. It's more related to long-term bond rates. And those are high for reasons not particularly closely related to Fed policy. But what John Burns Consulting is saying is the Fed owns $2.3 trillion in mortgage-backed securities. And the decision to buy, hold, or sell mortgage-backed securities does impact the rates. Okay. And so the chart this chart right here shows the unprecedented level of buying mortgage-backed securities. Okay. The blue is representative of the mortgage-backed securities. Okay. Look at this. The level has swelled in recent years. Okay. The green represents the treasuries, including long-term treasuries. So in 2009, the Fed began manipulating mortgage rates by buying mortgage-backed securities for the first time. So this is the first time, 2009, after the great financial crisis and the loan crisis, that the Fed started buying mortgage-backed securities. And look at, you could understand in 2009 why, but it continued and got bigger. Okay. So the extra demand for mortgage-backed securities drove the rates down. A few years later, these purchases helped stabilize home prices. Okay. Because home prices, remember, were falling off a cliff in 2009. There's never been another point in history that you can point to that type of rapid home price depreciation off of cliff levels. And so this unique policy worked to stabilize the economy and housing. Like the U.S. economy, as we know it, was almost over. In an attempt to stimulate economic growth, the Fed kept buying mortgages after the housing market recovered. For years, they purchased 25% plus of all mortgages issued in America, creating artificial demand for the mortgages. That artificial demand obviously drove the mortgage rates down. The Fed is a big reason that many homeowners today have sub 5% fixed rate mortgages. Okay. As you can see in the chart below, Fed policy shifted to stop buying mortgage-backed securities in 2019, 2020, and then 2023, 2024. 2024 to try to get inflation down. Mortgage-backed security owned gradually declined for mortgage payments. The Fed's current policy of not buying mortgages is contributing to a higher than usual premium. So the Fed's current policy of not buying mortgages is also contributing to a higher than usual premium because that demand has evaporated from the market. Now, the other side of this is like, yeah, because the demand before was artificial, and we should be getting back to a place where we can correct the money printing mistakes that Congress has made. The John Burns consultant here says, huge fan of Jay Powell. And listen, I think, like I said it yesterday, Jay Powell's made a couple big mistakes, but overall has done a job that I think is kind of unprecedented in a lot of ways. So says huge Jay Powell fan. I'm definitely not saying the Fed should start buying mortgage-backed securities again. Okay, so that is, and I'm leaning in that camp. Okay, so the headline on the Expo is like, hey, Powell's misleading Congress, but the Fed has made the decision not to buy mortgage-backed securities. So they're not really misleading in the sense that it's like, we've made this decision that we need to get inflation down. The dual mandate is 2% inflation, maximum employment. So we're not buying mortgage-backed securities. We stopped in 2023, 2020, beginning of 24. We're not buying mortgage-backed securities. It's not on the table because we can't get back to 2%. Because if we start buying mortgage-backed securities again, yes, the rates come down, but we believe, the Fed, that inflation moves back up. So the John Burns consultant agrees with Powell that factors beyond his control, such as fiscal and geopolitical politics, are pushing long-term rates. Nonetheless, mortgage rate manipulation became a policy tool. The Fed remains, it's a tool that is now, it's in the shed. It's not in the tool belt. I'm out here working on the house. I got the tool belt. But in the truck with the rest of the tools, in the tool shed, that tool is put away. It's locked up. The fact that the Fed kept buying MBS long after the great financial crisis ended, probably a mistake, and continues to own $2.3 trillion in MBS today, needs to be articulated more often. The bigger mistake is that the Fed did kind of encourage that last bite of the apple from Congress on that last $2.3 trillion on the infrastructure bill that just pumped a whole bunch of money into the system for no reason at all. COVID was over. Like, we knew what it was. We knew how to handle it. Like, were there still people wearing like a disposable mask with like brown stains all over it, and it was dirty, and it's like, dude, take the binky out, like it's over? Yes. There were still people doing that. Smart people were getting one that they could wash and staying sanitary if they were still using a mask. But it was over when that infrastructure bill came out. Some people came to that realization before others. But to pump $2.3 trillion into the economy, and then the Fed continued when inflation popped up at the beginning to buy mortgage-backed securities. They should have stopped mortgage-backed securities immediately. They kind of weaned off the mortgage-backed securities, okay? They slowly came off of that. So that's the other side of that. Ultimately, the path that the politicians asking Powell all these questions, the path that they can control on getting inflation down and getting the 30-year fix down is making decisions that they don't want to make, and that's both sides of the aisle. You'll see when these deficit conversations that Doge is trying to push, where he wants to cut all these different things, when it gets into the budget, you're going to see the right squirm as much as the left. Like, both sides of the aisle want to spend money. They've been on this drug for too long. They don't want to go to rehab. They don't want to go back to their constituents and say, I wasn't able to pull through. And that's one of the problems here, is ultimately we got to get our finances in order if we're going to have investment into America long term, and that's going to impact those long-term rates. And Barbara Corcoran says it. She was on Fox Business recently as well. Why were all these people on Fox Business? Corcoran, Serhant, because Fox hosted the Super Bowl, and they had a little little thing down there, I believe. Anyways, popular real estate entrepreneur insists U.S. is still suffering through a difficult market. So it's gonna remain a difficult market. I had a somebody tweet back last night. This was a brilliant tweet. I thought, anyways, in response to the 6% statement that I made. Where is that response? So Charlie Foxworth on X said that he keeps repeating what Lance Lambert said on the Knowledge Brokers podcast, separate channel Knowledge Brokers podcast on YouTube, regarding the research on real estate sales compared to the year before. Like the market's going to take a minute to come back. What Lance Lambert said on the pod, and I thought he broke this down really well. Like if you look at most years, and you can do this in your MLS and look at the line graph go up and down, most years are very similar to the year before. So this year is going to be most similar to 2024 without a black swan event. Obviously, second half of 2020 was wild. 2021 was wild. Black swan event, COVID. But most years going back to history are very similar to the year before. We had very low sales last year. The likelihood is that this year is going to be more similar to last year. Barbara Corcoran says, no one wants to move, and there are fewer houses to choose from at higher rates. So that no one wants to move, yeah, some people are in the perfect house, and then some people can't afford to move would be my edit there. So it's difficult for this group of home buyers, Corcoran says. Mortgage rates are moving down by a fraction of a point, but then we look yesterday and they're at 7.13 when last year on that same day they were at 6.96. So they're still not really moving down. We get moments in time, but really not. And there's, like what Serhant said, like he could see, he's not predicting it, but he kind of predicted it, but he's not guaranteeing it, that we could see 7.8, 7.9% 30-year fixed before we really start to see this thing move down. However, in Corcoran's view, rates aren't low enough for sellers to list their home. And so more than half of the homes in the market have been listed for 60 days. They seem too expensive for the would-be buyers. Mentally affects the housing market because people are waiting for very good news, and coming down a tenth of a point is not really good news. Went from 7 to 6.9. Psychologically, that makes a difference, but with interest rates remaining high, what it really causes is fewer houses on the market, and that's what we continue to see in most areas. Fewer houses on the market and fewer transactions. The mental barrier, the reason I put out the tweet yesterday about in 18 months, 6% is going to feel low because we're going to continue. We don't have a solve for the Fed's not buying MBS. We haven't solved the deficit, like finding $1 billion that USAID wasted we haven't found $1 trillion. We have a $2 trillion deficit. We need more. Okay. We need to make real decisions on what we're going to cut. So one of those things has to happen. We don't have the answer in February of 2025 in front of us. It hasn't presented itself. This is going to all take time to work through the system. Both things could be true where like they cut a bunch of stuff. Inflation does move down and obviously the long-term rates improve and the investment in America's future improves, or like they cut a bunch of stuff, but then spend over here and inflation stays high. There's going to be time for either scenario to play out. All right. We've got unemployment obviously also impacting rates a little bit as well. So we keep our eye on this. Overall economy impact. The week ending February 8th, initial claims moved to 213,000, which was a decrease from 7,000 from the previous week. So unemployment still just kind of moving sideways. The job market has softened, but we're not seeing any real movement there. Last thing I'll mention here in case you miss it, there's an article on BAM Zillow's earning reports just came out. Kind of took a big hit, by the way, on Zillow. They were at like 88 before earnings, 87, dropped down to like 77 after earnings. Even though they had revenue growth, they met expectations, wasn't big enough for Wall Street. So they reported a 25% rental revenue growth in 2024, or in quarter 4 of 24. And at the same time, they announced a Redfin partnership. Yes, Redfin and Zillow are now partners. Realtor.com has a little bit of a partnership with Zillow as well. So Zillow making strategic alliances with some of the portals. This was a $100 million deal. Redfin got rid of their multifamily rental listings with properties of 25 units or more. So Zillow is now the exclusive provider in this partnership with properties of 25 units or more. Obviously, this is a direct competition at CoStar, LoopNet. So Redfin, Rent.com, ApartmentGuide.com. Those are Zillow's the exclusive holder of this. So Zillow Rentals had a remarkable 294, gaining more property listings, yada, yada, yada. This deal shows Redfin continuing to try to really trim down what the business model is for them into a brokerage with the best website out of the brokerages, right? Like that's what they're doing here. They're not doing anything other than trimming everything away and trying to focus on brokerage activity. They laid off they let off 450 people from the rental division after agreeing to this $100 million deal with Zillow. It makes Zillow the exclusive provider of multifamily rental listings. So Zillow continuing to trim down. They are just focused on being a broker. They have yet to make that a profitable business, but that's where they're at. All right. 30-year fix again ended yesterday at 7.13. We'll see where we end the week heading into the weekend. CME Group is projecting now, after the inflation news, a 97.5% chance that there will be absolutely no short-term rate cut from the Fed. There you go. I'd love to see you over, as mentioned earlier, inside of BAMX. Go to school.com/BAMX. You can get locked in right now at a rate well below the new rate going into effect in a couple of weeks. So make sure you take that opportunity. You get grandfathered in for life at your current rate on BAMX. Get all of the information that we share here curated for you each and every single Hot Sheet show. As you can see there inside of the Hot Sheet classroom, as well as access to all of our live events in the community. No more Facebook spam. Get over to bamxschool.com/BAMX. All right, that's your Hot Sheet for the week. I got a couple guests coming on to Knowledge Brokers Pod tomorrow. So go over to Knowledge Brokers Pod. Make sure you get ready to subscribe. Notification bell on for that tomorrow. Later today here on this channel, we'll have the walkthrough podcast. Make sure you're subscribed here as well. See you guys all soon. Thanks for a great week on the Hot Sheet. And of course, until next time, toodaloo.